today we are going to discuss a subject accountancy for class 12th, right? So in this class we are going to discuss about the important notes, and it's going to be a quick revision which will be helpful for your examination point of view, right? The subject is about accountancy for class 12th, and it's going to be for non-for-profit organization and partnership accounts. So in this we are going to discuss about chapter number 3, that is Reconstitution of a partnership firm, admission of a partner. So this is a chapter that we are going to discuss, and it's going to be a quick revision. Only the important basic concepts which is important for your examination. So only those concepts will be discussed, right? So here the first thing is that about introduction and new profit sharing ratio and sacrificing ratio. So we are going to have a look at about what new profit sharing ratio and sacrificing ratio. First thing is that we have to discuss about the meaning. So under meaning, let's discuss that admission of a partner is one of the modes of reconstituting the firm under which old partnership comes to an end and a new one between all partners. So what do we have to understand? Admission of a partner is one of the modes of reconstituting. So it's a process of reconstituting or a mode of reconstituting the firm under which old partnership comes to an end and a new one between all partners, including incoming partner comes into existence. So they'll be coming into a picture, right? Next. According to section 31 subsection 1 of Indian Partnership Act 1932, a new partner can be admitted only with the consent of all the existing partners. Right here the basic thing is what? As per the section 31 and subsection 1. So this is as per the Indian Partnership Act 1932, a new partner can be admitted. When they can be admitted is that only with the consent of all the existing partners. Fine. So this is a basic thing that we have to understand. And again, a new partner is admitted for the following purposes. When do we have to admit a new partner is that, and for what purpose we have to admit is that for procuring additional capital, right? To procure additional capital, there is a requirement of new partners. That is the one of the purpose. And the second purpose is for acquiring additional managerial skills, right? So for acquiring additional managerial skill also, that is the other purpose for which a new partner should be admitted. Fine. Then a newly admitted partner acquires following two main rights in the firm. So what is the heading? That a newly admitted partner is going to acquire following two main rights in the firm. So first one is that under that share in the future profits of the firm. So here it's going to be related to what? A share in the future profits of the firm. And second one is about share in the assets of the firm. So here the two keyword that you have to understand here is that it's going to be share in the future profits of the firm. First one. Second one is that share in the assets of the firm. So this is the two important rights in the firm, right? Next. Adjustments required at the time of admission of a new partner. Under this, the first point is calculation of new profit sharing ratio and sacrificing ratio is the first one. So what are the adjustments that is required at the time of admission of a new partner? Whenever we are going to take up a new partner into the existing partnership firm, what are the adjustments that we have to do? So that's the thing that we are discussing here. The first step is to calculation of new profit sharing ratio. The first step is to what? To identify the new profit sharing ratio, because when one person is added extra, the profit cannot be shared in the same old profit sharing ratio. So that is the reason whenever the partner is getting admitted to a partnership firm, a new profit sharing ratio should be identified, and sacrificing ratio also, right? Then the second step is for accounting treatment of goodwill. Second step is to identify or accounting treatment of a goodwill, right? And the third step is accounting treatment of revaluation of assets and reassessment of liabilities. So the third step is what? Accounting treatment of revaluation of assets and reassessment of liabilities. accounting treatment of reserves, accumulated profit and losses. So here you can also find accounting treatment of what? Reserves, accumulated profit and losses. And fifth one is that adjustment of capital. Fine. Then new profit sharing ratio. The third thing is that to understand about new profit sharing ratio. So how do we understand this is that the ratio in which all the partners including incoming partner sharing the future profits and losses is what is known as what? New profit sharing ratio. Therefore, what we have to keep in our mind is that whenever we have to understand the concept of new profit sharing ratio, it's a ratio in which all the partners including the incoming partner share the future profits and losses, and this is what we call it as new profit sharing ratio. So how do you find out this? New profit sharing ratio is equal to old ratio minus sacrificing ratio. We will be able to identify the new profit sharing ratio. Fine. Then sacrificing ratio. So let us discuss about sacrificing ratio. So it is the ratio in which the old partners have agreed to sacrifice their share of profits in favor of a new or incoming partner, right? So it is the ratio in which the old partners have agreed for what? In order to sacrifice their share of profits in the favor of a new or incoming partner. So here we can identify, we know the formula, let us understand the formula. So sacrificing ratio is equal to old ratio minus new ratio is a formula that we have to apply in order to identify the sacrificing ratio. So it's a difference between old ratio and a new ratio in simple terms is what we call it as sacrifice. And next, treatment of goodwill. So let's discuss about the treatment, that is accounting treatment of goodwill. So when a new partner is admitted, a share in future profits of the firm is equal to the sacrifice of profit by an existing partner or partners of the firm. The amount he pays to compensate for this sacrifice is called goodwill. Right? So what do we have to understand about goodwill is that when a new partner is admitted to the existing partnership firm, okay, is the share in future profits of the firm will be equal to the sacrifice of profit by an existing partner or partners of the firm. The amount that he pays to compensate for this sacrifice is what we call it as goodwill. Various cases which are related to the treatment of goodwill. So let's discuss about these various cases which are related to the treatment of goodwill. So under this, when a premium for goodwill is paid privately by a new partner, in case a new partner pays premium to the old partners privately or directly or outside the business, it will not be recorded because it is an out of business transaction. Right, here you can understand when a premium, okay, we have already also discussed about the concept called premium. What is premium? The extra money that we are paying for the share. So when a premium for goodwill is paid privately by a new partner, in case a new partner pays a premium to the old partners privately or directly or outside the business, it will not be recorded. Why? Because it is an out of business transaction we are going to consider. Fine. Then, however, entry will be passed for capital brought in by a new partner. Then, however, whatever the capital that is bought by the new partner, even there will be a entry will be passed for this also. Right. When premium for goodwill is brought in business by new partner in cash and retained in the business. Right. So when premium for goodwill is brought in for business by new partner in cash and retained in the business. Write off the existing goodwill, if any, appearing in the books of the firm. So this is the next step that we have to understand. We should focus on write off the existing goodwill. Okay, if anything is there which is appearing in the books of the firm. How do we do that? Old partners capital account debtor, that is in the old ratio, to goodwill account. This is a journal entry that we have to pass at this time. Okay, at this situation. For bringing premium for goodwill and capital in cash, the entry would be cash or bank account debtor to premium for goodwill account, then to new partners capital account. So the entry is cash or bank account debtor. You have to debit cash or the bank because the money will be coming in. To what? Premium of goodwill account. Again, to new partners capital account. This is the entry that we have to pass for bringing the premium for goodwill and capital in the cash. The next situation is for distributing premium to sacrificing old partners. That is sacrificing ratio in the old for the partners. So this is for the purpose of the entry is for the reason that for distributing the premium to sacrificing partners. Okay, in the old ratio. So the entry would be premium for goodwill account debtor to sacrificing partners capital account. Right. So this is the entry that we have to enter for this. Right. Then when premium for goodwill is brought in kind. So whenever the premium for goodwill is brought in kind, at that situation for bringing premium for goodwill and capital in assets. So the entry would be assets account debtor to premium for goodwill account and to new partners capital account. So this is a journal entry that we have to pass for this situation. So assets account debtor to premium for goodwill account, then to new partners capital account. Fine. Then for distributing premium to sacrificing partners in their sacrificing ratio, the entry would be premium for goodwill account debtor to sacrificing partners capital account. So what do we have to pass the entry here is that for the situation that distributing premium to sacrificing partner in their sacrificing ratio, the entry would be premium for goodwill account debtor to sacrificing partners capital account. Fine. Then when premium for goodwill is brought in by new partner and is withdrawn by old partners for fully or partly, for this we have to pass a journal entry for bringing the premium for goodwill in cash by new partner cash. For this situation, it's going to be cash or bank account debtor, the amount of premium also to premium goodwill account. This is a journal entry that we have to pass, right? Then for sharing of premium of goodwill by sacrificing the partners, fine. Under this we can pass a journal entry that premium for goodwill account debtor, the amount of the premium that we have to enter with to sacrificing partners capital account, that is in sacrificing ratio we have to make an entry, right? So the entry is what? Premium for goodwill account debtor to sacrificing partners capital account. Fine. Then for withdrawal of premium money by sacrificing partners fully or partly. So for this situation the entry it's going to be sacrificing partners capital account debtor, that is amount withdrawn, to what? Cash or bank account, because the cash or bank is going out. So that's the reason whenever we get a situation, the transaction related to withdrawal of premium money by sacrificing partners fully or partly, at this time the entry would be sacrificing partners capital account debtor to cash or bank account. Fine. Then when a new partner brings only a part of premium for goodwill in cash for amount brought in by incoming partner, the entry would be cash or bank account debtor to premium for goodwill account and to new partners capital account. So this is a journal entry that we have to pass for this situation, right? Then for distributing the total goodwill due from incoming partner to sacrificing, which should be distributed in the old profit sharing ratio to the partners in their sacrificing ratio, the entry would be premium for goodwill account debtor, new partners capital or current account debtor to sacrificing partners capital or current account. So this is a journal entry that we have to pass for distributing the total goodwill which is due from incoming partners to sacrificing partners in their sacrificing ratio. Fine. Then when the new partner is unable to bring his share of premium for goodwill in cash or kind, new partner's capital or current account debtor to sacrificing partner's capital or current account. So the entry or the situation is where when the new partner is unable to bring his share of premium of goodwill in terms of cash or kind. So at that point of time, the entry would be new partner's capital or current account debtor to sacrificing partner's capital or current account. Fine. The third point is about hidden goodwill. So what is it is that hidden or inferred goodwill is the excess of desired total capital of the firm over the actual combined capital of all the partners. Right? Here you can understand hidden or hidden goodwill is what? It is the excess of desired total capital of the firm over the actual combined capital of all the partners. In case the value of goodwill is not given at the time of admission of a new partner, it is required to be calculated on the basis of an inferred method of profit sharing ratio, or which we also call it as capitalization. Right? So it's going to be what? Desired total capital of the firm over the actual combined capital of all the partners. Right? In case, why do we have to understand about is that the value of goodwill is not given. So if you don't find the value of goodwill, okay, at that time of admission of a new partner, it is required to be calculated on the basis of an inferred method of profit sharing ratio, or what we call it as capital. Now here we have a format of calculation of revaluation account. The first basic thing is to write the heading and draw the columns, the debit side and the credit side, and always debit side should be this side and credit side should be that side, and particulars amount you have to draw the columns. So towards your debit side, to concerned asset account, you have to debit asset account and the amount will be, you're going to retain the same. Then concerned liability account also should be included, which we can consider it as net increase. And to all partners capital account, that is being profit on revaluation shared in old profit sharing ratio should be written here. And towards your credit side, you can see that by concerned asset account, and it's going to be considered as a net increase again. And to concerned liability account, it's going to be considered as a net decrease here. By all partners capital account, that is loss on revaluation shared in old profit sharing ratio, if you find, that is the amount that you have to write it here. That is, if you get a balance this side, that is what the balance will be considered. If you get a balance this side, we call it as profit on revaluation, which is shared in the old profit sharing ratio, and we call it as to all the partners capital account, the amount will be distributed. Accounting treatment for reserves undistributed profits, or what we call it as losses. Right? So let's discuss about this. The new partner is not entitled to any share in undistributed profits or losses which is appearing in balance sheet at the time of admission, as these are earned by the old partners. Therefore, so these should be transferred to old partners capital or current account. Fine. Then journal entries passed will be like this. The first for undistributed profits. Right? General reserve account, profit and loss account, workman compensation account, then investment fluctuation account between book value and market value. Fine. Then to what? Old partners capital or current account. So this is the entry that we have to do. And for the second one, for undistributed losses, the entry would be old partners capital or current account debtor. So amount would be based on the old ratio. To profit and loss account and to deferred revenue expenditure account. So this is the entry that you have to pass for this. Right? Then further, adjustment of capital. So here you can understand that at the time of admission of a new partner, the partners may agree that their capital should also be adjusted so as to be proportionate to their profit sharing ratio. So here you can understand at the time of admission of a new partner, the partners may agree that their capital should also be adjusted so as to be proportionate to their profit sharing ratio. Fine. Then the capitals of partners may be adjusted in any of the following ways. right? The first method is that adjusting the capitals of old partners on the basis of the capital of incoming partners. So the first thing is that about adjusting the capital of old partners on the basis. On what basis you have to adjust is that based on capital of incoming partners. So whatever the capital that is bought by the new partners, depending upon that they have to adjust the capital of the old partners, right? When the total capital of the new firm is not given. Fine. Then the steps involved in adjusting the capitals of old partners. So under this, step 1 is what? Calculate total capital of the firm on the basis of capital of new partner. Step 1 is what? You have to calculate the total capital of the firm on the basis of what? Capital of new partner. That is step number 1. Step number 2 is what? Calculate the new capitals of each partner. How much they have bought. Okay, and step number 3 is ascertain the present capital of old partners which is adjusted. Okay, so the third step is to ascertain the present capital of old partners. Calculate the surplus or deficit capital by comparing step 2 and step 3. So this is how we have to calculate your step 4. So that's the reason you have to calculate step 1, step 2, step 3. So step 4 will be easy because it is going to be the surplus or deficit capital by comparing step 2 and step 3. Determining the new partner's capital on the basis of combined capital of old partners, the steps involved in the determination of capital of a new partner, right? So again, this is about to what? Determining new partner's capital. How do you determine the new partner's capital? On the basis of combined capital of old partners. The steps involved in this determination of capital of step is calculate the adjusted old capital of old partners after all adjustments have been made. This is the first step. Second step is to calculate the total capital of the new firm. The first step is what? You have to find the adjusted old capital of the partners. Okay. The second step is to calculate the total capital of the new firm. And the third step is to calculate the total capitals of the new partners as follows. That is, how do you calculate this? Is that step 2 into share of new partner. So this will give you the calculation of total capitals of the new partners, right? So with this, we are going to wind up the today's session. Thank you all.